Hello, my name is Michael Sullivan. I'm a wealth advisor with the Wealth Management Group, and I'm going to be spending a few minutes today discussing Roth IRAs, as well as a few of the differences between Roth IRAs and the retirement counterpart, the traditional IRA. I like to begin every presentation with a brief history lesson. IRA is simply an acronym for Individual Retirement Account. The first IRA was created on September 2nd, 1974, with the passing of one of the largest pieces of employee protection legislation ever passed, the Employee Retirement Income Securities Act of 1974, or ERISA for short. The IRA, or regular IRA, as it was originally named, was created as a vehicle which would allow employees the ability to set aside pre-tax funds for retirement. These funds would also grow on what is referred to as a tax-deferred basis. This means that while the money inside of the IRA grows, it is not taxed. Money inside of IRAs would only be taxed upon distribution. Distributions can occur in one of two ways, early or normal. The IRS has chosen the magical age of 59 and a half as the age that delineates early distributions from normal ones. If you were to take a distribution from your IRA after achieving the age of 59 and a half, then you would only have to pay ordinary income tax on your withdrawals. If you were to take money out of your IRA prior to attaining age 59 and a half, then you would also be subject to a 10% early withdrawal IRS penalty on top of ordinary income taxes. The first IRAs allowed participants to invest 15% of their wages, salaries, and tips up to a maximum of only $1,500 per annum. A few years later, the passing of the Tax Reform Act of 1986 renamed regular IRAs traditional IRAs, and also bumped the maximum contribution amount from $1,500 per year to $2,000 per year. Slightly more than a decade later, a new piece of legislation would create a brand new kind of IRA, the Roth IRA. Senator William Roth of Delaware introduced the IRA that bears his name today as part of the Taxpayers Relief Act of 1997. The Roth IRA was different from traditional IRA in both how the money is initially invested and how the money is withdrawn. Money invested in Roth IRA is after tax, and that is to say that the money contributed to a Roth IRA has already been taxed, and unlike a traditional IRA, you receive no immediate tax incentive for contributing funds. This is, of course, unless your income level qualifies you for the Savers Credit, and I would refer you to your CPA or to IRS Publication 590 to determine whether or not you would qualify. The Roth IRA grows the same way as traditional IRA. Again, it's tax deferred, meaning that you will not pay taxes as the money grows. But the biggest difference between these two types of IRAs occurs when the money is withdrawn inside of retirement. So as long as you have held your Roth IRA for longer than 5 years and you are older than the magical age of 59 and a half, you can withdraw funds from your IRA 100% tax-free. Here's a diagram that outlines the differences between traditional and Roth IRAs. As you can see across the top, we have traditional IRA versus Roth IRA, and along the left side we have how the money goes in, how the money grows, and how the money is eventually withdrawn inside of retirement. The money goes into a traditional IRA pre-tax, which is opposite of the Roth IRA, which goes in after tax. The money in both types of IRAs grows tax deferred, but the big difference is how the money is withdrawn. Inside of a traditional IRA, the money is taxable at ordinary income inside of retirement. The Roth IRA, however, is 100% tax-free. There are, however, some caveats when it comes to Roth IRAs. The IRS, unfortunately, does not allow everyone to contribute to Roth IRAs, and you must fall under a certain income threshold, which is constantly changing. As I speak today in 2012, your eligibility to make Roth contributions phases out between $110,000 and $125,000 of modified adjusted gross income if you file single, and $173,000 to $183,000 of modified adjusted gross income if you file jointly. Many people are not able to contribute to Roth IRAs because they simply make too much money. And while this has been the case since Roth IRAs were created in 1997, recent sunset provisions from legislation passed in the early 2000s has opened up new opportunities for investors that had previously been unable to open Roth IRAs due to income restrictions. I will touch on this point very briefly at the end of this video. Although they have been increased in recent years, contribution limits are the same for traditional IRAs and Roth IRAs. For 16 years between 1986 and 2002, the maximum contribution amount was $2,000 per year. The contribution limits began rising as a result of EGTRA, the Economic Growth and Tax Relief Reconciliation Act of 2001, and as of 2012 are now $5,000 annually if you are under the age of 50 and $6,000 annually if you are over the age of 50. The extra $1,000 you are able to contribute if you are over the age of 50 is commonly referred to as the catch-up provision. Lastly, there are a couple of other key points you should know regarding Roth IRAs. Number one, and possibly most important, Roth IRA contributions can be withdrawn at any time for any reason, tax and penalty free. I'll say that again. Roth IRA contributions can be withdrawn at any time for any reason, tax and penalty free. Why is that, you ask? Well, it's because you've already paid taxes on your contributions. So the government allows you to withdraw what you have contributed. They will not, however, allow you to withdraw your gains. So let me give you an example. Let's say you have a Roth IRA worth $32,000, to which you've contributed $5,000 per year over a 5-year period, or $25,000. If you wish to take a withdrawal, the IRS would allow you to withdraw all of your $25,000 initial investment. The remaining $7,000 of growth would need to stay in the Roth for a minimum of 5 years or until age 59 and a half, whichever is longer. If the $7,000 is withdrawn prior to 59 and a half, it would be subject to ordinary income tax plus a 10% IRS penalty. Another question I often get is, how do Roth IRAs perform? Well, a Roth IRA's performance will directly be linked to whatever the underlying investments are within the IRA. As I stated in the beginning of the presentation, IRA simply stands for Individual Retirement Account. What you invest in inside of your individual retirement account will determine your rate of return. We, of course, normally recommend a diversified investment approach, but typical investments found inside of IRAs would be stocks, bonds, mutual funds, and exchange-traded funds, or ETFs. You could also invest in annuities, money markets, or even CDs inside of IRAs. The other question I sometimes get from beginner investors is, which type of IRA will perform better? Well, since Roth IRAs and traditional IRAs can invest in the exact same underlying investments, the only difference between these two types of accounts will be taxation. My final point involves the ever-changing world of Roth IRA conversions. There has been a lot of press on Roth conversions over the last several years, and while this point would more than likely be enough information for an entirely separate video, there is one key point I would like to make. Sunset provisions from EGTRA have lifted restrictions against those in higher income tax brackets from performing Roth IRA conversions. Because of these changes, it has become possible to make non-deductible IRA contributions regardless of income level and perform periodic Roth conversions to have the money transferred to your very own Roth IRA. The logistics of this transaction can be painstakingly complex, but the only point I would like to drive home during this video presentation is that if you have always been told that you are unable to contribute to a Roth IRA due to your income, there may now be a way for you to obtain a Roth IRA. Call or email us if you would like more information regarding this concept. In summation, Roth IRAs are a nifty little investment tool whose main strengths involve tax-free income in retirement and flexibility in that you can withdraw your contributions prior to retirement. Future tax laws, of course, may change at any time and may impact the benefits of Roth IRAs as well as their tax treatment. But for now, Roth IRAs remain what should be a very, very important piece of your retirement puzzle. Many investors have also noticed that their 401ks at work have begun to allow for Roth 401k contributions. And this is another area that should be discussed with your advisor in order to determine the best and most efficient way for you to continue making 401k contributions. As always, for any other questions you may have regarding traditional IRAs, Roth conversions, or investments in general, please feel free to contact us anytime. Again, I'm Mike Sullivan with the Wealth Management Group. Thank you for investing time with us today.